Good afternoon, and thank you for joining us today. I am Arno, the Group's Chief Finance and Value Management Officer, and today I'm going to share our 2025 financial roadmap with you. I would like to start by sharing some of our thinking on resource allocation, and I will then share our medium-term targets with you and wrap up why we believe the SBK share is an attractive investment proposition. I would like to start the resource allocation discussion by taking a step back and reflecting on the size and strength of the Standard Bank Group. Our common equity Tier 1 capital base of 169 billion rand has grown steadily and has been managed in excess of regulatory requirements. Our liquidity ratios have also been consistently strong. Our vast financial resources give us confidence in our ability to support the growth of our client franchise, as well as the financial means to access and to deliver on new growth vectors you have heard about this morning from our client segments. On this slide, we reflect on our track record of a strong risk management and our ability to manage stable returns in excess of our cost of capital. The COVID-19 pandemic has clearly interrupted this trend, but our recent results evidence our ability to withstand a 1-in-100-year event. Our risk and return metrics are rapidly recovering to pre-pandemic levels. Our resource allocation framework is illustrated on this slide. The important points to note here are that our allocation processes start with a client need. Gated hurdle rates are used to assess the attractiveness of the investment, and targeted metrics are continually assessed to manage progress and delivery. We have also embedded the discipline of scenario planning to better anticipate and plan for a future characterized by heightened volatility and complexity. Through the process we illustrated on the previous slide, we have made meaningful shifts in our capital allocation since 2014. We have tilted capital allocation to higher return products, namely insurance and investments, and higher return regions. Other group entities in 2014 comprised our investments in Russia, Argentina, and Standard Bank plc in London. In 2020, just 5% of the group's NAV remains invested in our 40% stake in ICBCS. Over the period illustrated here, an incremental 36 billion rand of capital has been invested in our Africa region's legal entities, yielding an average annual total return of 18% to 2020, thus supporting our decision to allocate capital to these higher growth markets. Turning to the future, we will continue to allocate our resources to deliberately tilt our portfolio of businesses. Clearly, our core banking franchise in South Africa is our mainstay franchise, and it will continue to grow and deliver good returns. This will require continued resource allocation, but with a focus on optimization and efficiency. We will continue to look for resource allocation opportunities in capital-efficient businesses, in insurance and investment activities across sub-Saharan Africa. The Liberty transaction is an important part of this strategy and will help us achieve this portfolio tilt. We will continue to invest in high-growth markets in sub-Saharan Africa. Sim has illustrated the strong demographic trends that support growth in these economies, and we will allocate capital, investment spend, and people to capture this growth. We understand the risks inherent in these growth markets and have proved that we have the on-the-ground capabilities and portfolio diversification to mitigate these risks. Finally, we will be investing in scaling new business models. We will allocate incremental capital and invest in new capabilities and partnerships that allow us to capitalize on the network effect that ecosystems and platforms reveal. This slide summarizes the client segment focus areas, which you have heard about this morning in detail from the client segment and solution heads. Our prioritized resource allocations follow accordingly. Through this deliberate and targeted approach, we are unlocking new growth vectors to deliver superior shareholder returns. The client segment strategies will require resources, and this slide illustrates how we think those allocations will play out in terms of growth, risk, as well as returns. We expect to grow our allocation of capital to our core banking franchise in South Africa, but through capital optimization strategies and faster growth in other areas of the group, banking in South Africa is expected to amount to just over 50% of the group's NAV by 2025. Continued growth in earnings will support an increasing ROE. We expect our existing and large insurance and investments businesses in South Africa, Nigeria, and the Channel Islands to grow faster than banking. And we are also seeing exciting opportunities to expand our insurance and investments businesses through our ecosystems and partnerships models, as you heard from our client segment and client solution heads. The Liberty transaction will create opportunities for meaningful capital optimization. Insurance and investment businesses traditionally carry high returns, which we believe can be maintained and actually further enhanced through digital delivery. We will continue to tilt capital allocations to high-growth markets in sub-Saharan Africa. Across our portfolio of 20 countries, we have identified countries where capital is currently being actively allocated for growth, and other countries that will only require capital on a case-by-case basis. There are also those countries which are not expected to require additional capital and are focusing on optimizing the deployment of their current resources. In terms of new markets, we have entered the West African Economic and Monetary Union via Côte d'Ivoire, and the wholesale business there is making good progress. We're also reviewing entry options into Ethiopia, a market we believe presents compelling long-term opportunities. In order to scale new business models, we need to continue to invest in platforms, technology, and data, and we estimate will cost approximately 2 billion rand per annum. This is similar to the amount we have spent over the last few years. We have also set aside approximately $100 million per annum to invest in fintech partnerships to accelerate our growth strategies. This investment is expected to generate new revenue streams outside of traditional financial services. This slide sums up the portfolio tilts by showing the group's projected capital position in 2025. In the 2025 column of the NAV composition, you can see here Africa regions growing to almost 30% of the group's capital base, and the Liberty transaction increasing insurance and investments to around 14%. We also remain confident that we will exit our shareholding in ICBCS in the near to medium term. I'm now going to take you through the income statement to expand on our financial outcome targets for the medium term. Please note that we have kept Liberty and the potential benefits of integration separate, as we currently do in our reported results. Over the medium term, we expect interest rates to normalize from the lows in 2020. The impact of rising rates will allow for margins to expand by 40 to 60 basis points, and together with high single-digit growth in the lending book, net interest income is expected to grow between 7 and 10% per annum. Excluding the impact of endowment from interest rate normalization, NII will grow by 5 to 8% per annum. We are expecting an acceleration in growth in non-interest revenue. This growth is driven by new customers and increased cross-sell in banking and strong growth from our existing insurance and investments businesses. We also expect new revenues beyond traditional financial services to grow to 3 to 4 billion rand by 2025. You will recall Margaret spoke about these revenues as complementing our honeycomb of bank, insure, and invest. We currently generate approximately 350 million rand of this type of revenue from third-party solutions exposed to our clients on our app via airtime, electricity, and lotto sales. As our ecosystem and platform strategies achieve scale, we anticipate a meaningful increase. This revenue is currently captured within banking, and we intend to show it separately as a new product going forward. These impacts add up to a growth rate of 7 to 9% in NIR in the medium term. It is worth noting that most of this growth comes from Africa regions. South Africa's compound growth over this period is a more muted 5 to 7%. This slide combines NII and NIR on the previous slide to show a view of total revenue. Here you can see that we expect total income to grow between 7 and 9% per annum over the forecast period. We've analyzed the revenue growth in two ways. First, by client segment. Here you can see consumer and high net worth growing by 6 to 8% over the medium term, which Funeka took you through earlier. Business and commercial by 8 to 10%, which David outlined, and wholesale by 6 to 8%, which Kenny took you through. You can also see the planned revenue contribution resulting from strategic distribution partnerships, as discussed by Margaret, amounting to 5.5 to 6.5 billion rand per annum by 2025. In this type of partnership, we would be selling our solutions via an intermediary, either on a B2B2B or B2B2C basis. Secondly, we have analyzed the growth by product or solution. Banking activities benefit from interest rate normalization over the period to the extent of 6 to 8 billion rand in increased NII. Stripping that impact out, we forecast banking to grow by 6 to 8% per annum over the 5-year period. Insurance and investments is expected to grow strongly by 9 to 13% per annum. We have covered services beyond financial services on the previous slide. Turning to costs. By doing this, we have achieved cumulative savings in excess of 6 billion rand since 2015. The biggest drivers of this saving have been reduced headcount and premises costs, as well as automation and process optimization, some of which Alpheus referred to earlier. In thinking about cost growth, we will achieve our cost-to-income target by maintaining our track record of growing costs slower than inflation. We plan to grow costs by an annual 4 to 5% growth rate, while weighted average inflation across our markets is expected to be between 5 and 6%. Efficiencies of around 9 to 12 billion rand are expected to be banked through lower costs to originate and lower costs to serve, a further reduction in premises costs, and diligent management of IT system running costs, as outlined by Alpheus earlier. After efficiencies are accounted for, this would deliver a business-as-usual cost growth over the period of 2 to 3% per annum. But in order to deliver the revenue growth we have outlined, we will continue to invest in partnerships, new business models, data capabilities, and technology. By saving to invest, we can constrain cost growth over the period to 4 to 5% growth per annum, while continuing to build for the future. Our cost-to-income ratio has remained stubbornly high, and over the medium term, our target is to reduce this ratio from its current 58% to a ratio approaching 50%. The revenue targets that we have already spoken about deliver 5% of the cost-to-income ratio reduction, and we will be relying on cost efficiencies, which I spoke about, to deliver the remaining 3% of the cost-to-income ratio reduction. Analyzed another way, we can see that cost growth expectations of 4 to 5% per annum and revenue growth expectations of 7 to 9% per annum will deliver strong positive jaws over the period and allow the group's cost-to-income ratio to approach 50% by 2025. This slide illustrates again that the achievement of a 50% cost-to-income ratio relies on accelerated revenue growth as well as maintaining sub-inflation cost growth. Turning to credit provisioning. The introduction of IFRS 9 and the impact of the COVID-19 pandemic have resulted in a volatile credit loss ratio since 2018. Going forward, we expect the credit loss ratio to normalize between 70 and 100 basis points. Through our deep on-the-ground risk management expertise, we have proven our competitive advantage to manage our portfolio of risk across sub-Saharan Africa and have confidence of achieving a through-the-cycle credit loss ratio within the 70 to 100 basis points target range. Our capital management plans over the medium term reflect strong capital ratios above regulatory requirements and above our target for core equity tier 1 ratio of greater than 11%. We are planning continued issuance of AT1 as well as tier 2 capital to optimize our capital stack. Given the sustained earnings growth and strong capital levels that we have illustrated today, as well as the planned increased issuance of AT1 capital, we are confident that we can maintain a dividend payout ratio between 45% and 60% over the medium term. Now that we've covered earnings and capital, we turn to measuring returns. This slide illustrates the levers we have to return our return on equity to pre-pandemic levels. The majority of the uplift in return on equity will be delivered by our core banking franchise returning to pre-pandemic levels of credit provisioning. This will be supplemented by Africa region's earnings growth at relatively higher ROEs. Insurance and investments growth will be ROE accretive as our existing businesses grow strongly and Liberty returns to profitability. The integration of Liberty Solutions following the buyout of minorities will be ROE accretive on the back of transaction synergies and further capital extraction and optimization. In the near term, new business models will have a relatively small impact, but this is expected to become much more meaningful over the medium to longer term. Our primary measure of shareholder value remains return on equity, and the plans you have heard today will deliver a return on equity of between 17% and 20% in the medium term. With our cost of equity expected to remain at around 14%, these returns will deliver sustainable value over the medium term. This slide summarizes the group's medium-term financial targets. We anticipate revenues to grow between 7% and 9% per annum over the 5-year period to 2025. Based on these revenue targets and through continued disciplined cost management, we are targeting a cost-to-income ratio approaching 50%. We anticipate that the credit loss ratio will range between 70 and 100 basis points. The Liberty transaction and associated integration synergies will further underpin sustained earnings growth for the group. Diligent resource allocation and an increasing dividend payout ratio will drive returns. Our most important measure of shareholder return, the group's ROE, is expected to increase to between 17% and 20%. The group's core equity tier 1 ratio will be maintained above 11%. We acknowledge that many of these targets are similar to the ones you have seen from us before. We consider the 5-year period from 2020 to 2025 to be a recovery period coming out of the global pandemic, and these targets should be seen in that light. We will reassess our targets in 2025 or even earlier if necessary. By 2025, our platform business model you have heard about today will be well entrenched, and we are looking forward to setting post-recovery targets that will reflect exciting step changes and further increased shareholder value. On this slide, you can see a broader perspective of the group's targets over the medium term. We understand that financial targets are outcomes of actions taken in our strategic value drivers of client centricity, employee engagement, risk and conduct, and operational excellence. We have set ambitious targets for client experience, activity, and engagement that you heard about earlier today. By 2025, we aim to have 1.6 times as many customers as we do now, and we expect new revenue sources from strategic distribution partnerships and from non-financial services. By the same token, we want to keep levels of employee engagement, diversity, and productivity high. On risk and conduct, we always stay within the parameters set for us by regulators and risk appetite endorsed by our board. For operational excellence, we will track our decreasing cost to serve and ensure that our systems are always on and always secure for our clients. The combination of all of these actions and targets will lead to a financial outcome defined by sustainable growth in headline earnings and a return on equity in our target range. By 2025, we will also have made a positive impact in our 7 chosen social, environmental, and economic impact areas. And by 2050, we will have achieved our goal of net zero carbon. I would like to conclude with a few points summarizing the group's investment case. There are clearly compelling macroeconomic trends in the markets in which we operate. The pandemic and its socioeconomic effects will fade, and we can see exciting demographic trends providing growth and opportunity in sub-Saharan Africa. The Standard Bank Group has massive scale advantages arising from unparalleled brand strength and legitimacy worldwide, continent-wide, and in South Africa. We have a large and growing client base with winning client propositions and a significant opportunity to deepen client relationships and grow revenues by way of cross-sell. We will achieve this by using data, which is a significant differentiator for us due to our scale and our size. We will dominate the African data landscape in order to transform the lives of and create shared value for and with our clients and our partners. We have installed capacity in fast-growing sectors and geographies, supporting revenue growth through deepening product and market penetration by way of new digital channels and partnerships. We have deeply skilled and experienced people, indeed the largest and strongest financial services team on the continent, supported by financial resources and a large and increasingly efficient infrastructure to grow our client franchise. And we will leverage the network effects of strong and enduring partnerships and ecosystems, enabling us to generate more revenues with better cost efficiency. The scale and reach of our group is unique in Africa, as is our strategic partnership with the world's largest bank, Sbsu. Finally, we are driving sustainable growth and value. Inherent in our purpose, Africa is a home we drive her growth, is the commitment of delivering sustainable social, economic, and environmental value across sub-Saharan Africa. We have set compelling targets to deliver shareholder value. Today, we have demonstrated that execution is underway and that positive momentum is tangible. Thank you for your attention. I will now hand back to Sim to conclude ahead of the second Q&A session.